Hey everybody, welcome to this free edition of our Trader User Group weekly roundup for the trading week ending January 21st, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is like a clock. Tick tock, tick tock. You can hear it ticking. Does that mean the grenade's going to go off or the stick of dynamite's going to go off? Let's see what's going to happen here. If we take a look at the week, let's just take a look and just kind of zero in on this thing and see how things are shaking out. Okay. So if we look at the markets, you can see everybody was in the red. There's a lot of red on the screen here, index performance-wise. All right, it was just not pretty. Dow, S&P, Nasdaq, Russell, all down, and those are weekly numbers, not monthly numbers. Down solid. You can see both Nasdaq and Russell year-to-date are in official correction territory. Nasdaq, Russell for the week over 7%. Okay. U.S. valuations, you can see the PE ratios come down just a little bit, not by much, to 20.10. Dividend yield 1.38%, 10-year Treasury. Came off the highs earlier in the week, but it's still at 1.74. Earnings yield for the S&P still 4.6%. I will tell everybody that we'll still continue to channel money into the equity markets, regardless of the drop that we've seen as we've moved through this early part of 2022. Treasury yield, the yield over the Treasury yield rather is still 2.86%. So those numbers, even though they're in the green, understand the CPI came in at 7%, the PPI a little over 9%. So year to date, everything is still, if you factor in inflation, underwater. Okay. Current VIX had a very strong week, closing out the week at 28.85. The prior week, it was still a relatively high 19.19. So the VIX almost went up 50% for the week. And then, of course, the weekly sector performance, all in the red. Even the best sector, it was utilities. It was still finished down 81 basis points. And by the way, for the year, energy should not be in the red. It should be in the green, 12.52%. Okay, so that is the big, solid green factor for the year. Energy is moving up very strong. And as everybody knows, hard assets, especially energy and some commodities, when you've got rising interest rates and higher inflation, that's where you want to be. Now, I've worked with our members to give them a list of things where they want to be, focusing on near term versus longer term, beyond 6 months, I guess. But for our weekly update this weekend, weekly roundup, don't really have time to do that. You can see the worst sector year to date is discretionary, which is very similar to technology. For the year, it's down 11.75%. For the week, a whopping 8.19%. Really, really ugly numbers. From an economic data standpoint, really moving the markets lower. First, here in the U.S., it was a holiday shortened week, Monday being MLK Day. Nasdaq fell a very solid, robust over 7.5%. Same thing with the Russell for the week. By the way, that was the biggest weekly drop in the Nasdaq since the start of the pandemic in late February, March of 2020. Right. So we're in official correction territory here. All right. There's speculation on Wall Street. You're seeing some people out there saying they're going to hike the rates 50 basis points in March, but I don't believe them. They generally have stuck to a 25 basis point rate increase every time they do it. And Boom Boom Powell, our illustrious Fed chairman, or we call him Fed chair, Boom Boom Powell, Power Ranger Boom Boom Powell is what we officially call him in our group. He's been basically leaning more dovish than hawkish. So even his dovish or hawkish view would probably be a 25 basis point rate hike. Okay. Now the markets, the Fed Fund Futures is pricing in over a 66% chance that they're going to be 4 rate hikes this year. The markets have already priced in a 25 basis rate hike for the March meeting. Now we do have them coming up next week, and there is not a forecast for a rate hike next week. Okay. So just keep that in mind. The other thing you may have heard, so goes January, so goes the rest of the year here in the U.S. And just to put some stats on it, when the Nasdaq is finished down in the month of January, then you got a 50-50 shot of the year finishing off in the red, okay, for Nasdaq. When the Dow and the S&P have had a down January, then you get a 60% shot of the markets finishing in the red for the year. So January, even though it's a stat and you can still finish higher 50% of the time for Nasdaq according to the stat and 40% of the time according to the S&P and the Dow stats, anything can happen, but we're not off to a very good illustrious start for the year. Okay. Now, from an economic data standpoint, you can see that we've had a surprise drop in factory activity in the regional area of New York. That's the first drop since early 2020 as well, probably because they're shutting everything down again because of the big O. That would be Omicron. We're seeing related activity in the mid-Atlantic region coming down a little bit. Housing starts and permits in December. Actually surprised to the upside. Although weekly jobless claims jumped, rose up to 286,000. Again, mostly because a lot of people are shutting down and some people are still collecting checks not to work. I mean, you got to love that, right? And then, of course, if we look over at treasuries and yields, that's going to be in focus with the coming week. We did see the 10-year hit a high note of 1.9 last week. It's the highest level it's been at since 2019. Let me say that again. This past Wednesday, the U.S. 10-year Treasury hit a high of 1.9. Now, it closed out the week at 1.74, as you can see on the screen. But it hit 1.9. That spooked the markets a little bit, and we haven't seen that height since 2019. Okay. And it came back pretty good sharp because of the jobless claim report coming in rather weak. But we've got the upcoming Fed meeting and the press conference. And it's really flip a coin 50-50. Not in that we're going to have interest rate hikes. Everybody and their uncle knows rates are going up this year. That's not the takeaway. The takeaway is there's a lot of different paths Boom Boom Powell can take at that press conference. Okay. We got the rate hike trajectory, right? Meaning we know we're going up, but what is the ascension of that rate hike? What's the speed of the trajectory? That can throw the markets off. They can adjust that, and he can come out dovish and say, we're going to take it one step at a time, which is what I believe he's going to do. We also have another thing that can really set the markets off, and that's the runoff of the balance sheet, starting to reduce that. Most market participants don't believe that's going to start happening until the summer, May timeframe, but that also can set the markets off. They can move price action up or down very quickly depending on how Boom Boom Power reacts to the questions he's going to get this next Wednesday. So we've got a lot of room for Boom Boom to try and thread this needle. In other words, the eye of the needle is going to be a little bit wider here, so it's going to be a little bit easier for him to come out dovish, yet still indicate we're going to have some rate hikes. Because of this drop that we've seen so far, we've already got factored in a 25 basis point rate hike come March. All right. So let's see how that shapes itself up. Now, if we bounce over and take a look at Europe, you can see here across Europe, everybody was in the red there too, although the FTSE's the lone holdout year to date in the green at 1.48%. But the Euro stocks, FTSE, CAC 40, DAX, all in the red for the week. Not nearly as ugly as the U.S. markets, I might add, but still in the red, right? But like U.S. market, shares in Europe are a little bit lower. They've got the expectation that the ECB and Christine Queen Bee Lagarde, in charge of the ECB, is going to raise rates this year, but she came out and basically said they're going to take it slow, right? Well, okay, we'll take it slow. Inflation is very high there too, not like here in the U.S., but it hit a record 5% this past December. So we'll see where they're going, but that's well above the ECB's target rate of 2%. Much like our 7% is well above our target rate here at the U.S. Fed at, 2% too. So we'll see how that shakes itself out. Meanwhile, if we look at the Asian markets, while most banks here, central banks here in the U.S. and Europe and Canada are talking about being a little bit more hawkish and reining in the stimulus, over in the Asian markets, they're doing just the opposite. Bank of Japan is maintaining their dovish stance, right? Their monetary policy meeting, they're keeping short and long rates unchanged. Their central bank, the BOJ, came out and said they're going to continue with quantitative monetary easing. And they use the yield curve control aspect of it. So they're going to try and keep a very stable rate there. They also upgraded their forecast for economic growth in 22, expecting their GDP to come in at 3.8% compared to what they had said this past October at 2.9. So that's a full 1%, a little bit over a 1.1% bump in GDP. But even that, you can see the Nikkei is down year to date this year, and it's down 2% for the week. And then, of course, if we look at the rest of the bigger Asian markets, China, their bank is also stimulating. They're putting money in. They're cutting rates at the PBOC, the People's Bank of China, cuts loans to some of the financial institutions. That's how they cut their rates. They cut them by 10 basis points. They want monetary stimulus in their economy. And following that rate cut, the PBOC came out and also said China is going to probably roll out additional policy measures to stabilize the economy. Hint, hint, more stimulus. Okay. After they totally crushed the economy when Xi came out and did an attack on the education sector and the tech sector. So, as you guys know, equity markets love stimulus, and they don't like it when you take the punch bowl away. So, but right now you can see Hong Kong is in the green year to date and weekly, and China had a weekly green print for their markets, but they're still in the red year to date. So that's a little bit about where we're sitting right now. What I'm going to do is shift you over. Let's take a look at the charts. I'll show you kind of where we're sitting here. So bear with me as I shift my screen over. It's going to go blank here for a second or two. And then the first thing you guys are going to see is the E-mini S&P 500 futures. Okay. You're going to see we're down about 8.8% for the year, right? So that movement there being down 8.8%, you can see that we just closed slightly below the 200 EMA. Now that's a significant move there. And the 50 EMA is well north of the 200. So I believe that this pullback here is going to offer up some really great buying opportunities across all asset classes. Now, if you guys remember, I was calling for, and I've been with our members for the past 3 months, saying we're probably going to have an early 22 pullback of 10 to 15%. Okay, which would be correction territory, which we've had with the Russell. Russell, we're almost in bear market. I'll show you that in a minute. And Nasdaq, we've got that official correction. Okay, so but you can see here, and the next support area is down around the 4,200 area, 4,200 to 4,260. That's going to be the next big support point, to possibly give us that oomph and give us that official correction. I could see us having some kind of dead cat bounce and then rolling back over again. The speed with which we moved is just everybody rushing for the door at the same time. When you get everybody talking about now, let's take profits, and you can almost see here, the all-time highs were on January 4th of this year. And literally by January 21st, we've given it all up, right? I mean, you can just see that waterfall. Nothing changed from January 4th going forward. Everybody knew the rate hikes were coming. Everybody knew inflation print was high. So you got to understand the markets operate not on a fiscal basis, but a calendar year basis. So after the big money stayed in, you could see the last week of the year is pretty much running sideways. The minute that broke, you can see the 2021 closing price of 47.21. We briefly moved into the green, and then the selling began, right? As asset rotation started to happen, and we've had a lot of asset rotation. As I've told our members, we've rotated out of a lot of the growth stocks into the cyclicals. And I'm going to show you a chart here that is a customized index of cyclicals, right? And you can see here, comparing the cyclicals to the SPY, right here, the cyclicals have been coming down through the fourth quarter, right? You can see each month with this white dashed line, we've just steadily moved lower, hitting the apex low as we went into the end of the year. And then almost by magic, as the markets have fallen, cyclicals have outperformed straight through the roof, right? Driven primarily by commodities and energy, okay? Just straight through the roof, and some banking. And you can see where we're sitting right now near the 2022 highs for the cyclical sector or just cyclical stocks rather, over the S&P. Okay. Now, if we come back down and we take a look at the Dow, right? Let me just find the Dow on here. These are Dow Futures. If you look at the Dow Futures, you can see also well below the 50 or the 50 and the 200 EMA. We're down about 7.4%. We got a little bit further to go, I believe, another 1,000 points, 2,000 points or so. That'll give us that 10% pullback. I think we could get some bull traps in here. We may roll up a little bit, for a week or two and we roll over. But the big, who's the guy bringing the booze to the party? Well, that's Boom Boom Powell. And either he's going to get everybody numb and drunk, or he's going to, take the punch bowl away next Wednesday. And that's going to move the markets, guys. So just understand, if he comes out a little bit dovish, more dovish than expectations, we're going to see the mother of all bounces, but don't jump on it. If you want to swing trade it or day trade it, fine. But if we do get that bounce, I believe it's going to roll back over again. All right, let it bounce and then roll. Members, I'll work with you on that in a little bit more detail. If they come out more hawkish, then we're going to get that 10 to 15% that I believe. Okay, remember, the markets already expect at least one 25 basis point rate hike in March. They're expecting another one at the next quarter end as well. In fact, they're expecting 4. So we're going to see if market expectations are met, then we can start to get some settling in a price and moving higher. If that's not met, well, then we're going to go lower if it's worse than expectations. If it's better than expectations because Boom Boom Powell comes in and he does his traditional dovish stance, then we can see a big little mother load of counter-cyclical move here. Okay, so that's a little bit about the Dow. And then, of course, if we look at Nasdaq, I mean, Nasdaq's down hard, right? It's tech, it's growth. You can see here, if I move this down and just kind of put it down like this, you can see Nasdaq Futures 2022 low here. Now, I thought I had that marked up, but I guess I didn't. But if I were to do the math here on this and just take the 16, well, let me just do it an easier way. I'm just going to run a ruler on this thing and we'll see where it goes roughly. All right, so we're roughly about 13, almost 14% down from the all-time highs. Okay, so I had said the 10 to 15% really applied to the S&P. So if the S&P goes down 15%, I promise you Nasdaq will be down 18 to 20%, close to a bear market, but maybe not. All right, so this still would have another 2 or 3% to go, but beware of a bull trap run up and then a roll back over again. Okay. Now, if we look at the Fang Index, this is just an index of the Fang. You can see here, again, and let me just mark the low here on this. If I mark the low of the index Fang, where are we down? These are just the mega cap, which kind of pull the market higher. It's down almost 20%, almost in bear market just for the Fang, right? That's the low point right down there, almost bear market. Not quite, but that just shows you money's rotated out. So if the Nasdaq or the Fang Index, the mega cap growth, are down almost 20%, okay, and the S&P is only down 8% or so, then that shows money is going out. And as I showed you, money is coming into cyclicals and value stocks. So members, we'll review that a little bit more detail on our weekly market watch come Sunday evening. Okay. If we look at the VIX, you can see here, as I said, we're in the pink zone, almost in the red. We're in a down fast market zone for the VIX. Right. Now, if I back it out, right, you can see here we haven't been into the red more than a few days going back to 2021, February of last year, right? And you can see right here, we were in the red just briefly in December of last year. We only had a couple of bouts in the red for 2021. 2021 was relatively a quiet year, right? But if we come back out again, you can see we're in this cycle right here. So once we get up here, we usually don't stay up here more than a week before we get that bull trap, potentially bull trap run up, okay? So I will be expecting that either this coming week or next week. And you'll know it's going to be there because we get a 50 or 60 point move up. And instead of going into close hitting the lows for the day, it's going to hit the highs for the day. And it'll probably hold the next day and the next day. Then you're going to see the buy the dip crowd come back in, and then it's going to roll over again. All right. We got to take out key areas before I'm more of a believer in the buy the dip mode. All right. So that's one thing that we watch very closely here in our group. And of course, if we come into treasuries, I'm going to show you the 10-year. 10-year backed off, but it hit a high midweek. We came right up to my resistance point, right? And let me just move it here and get it accurately projected on here, right there. You can see on here, it hit 1.874, almost 1.9, but 1.87. If you were to round it, it'd be 1.9. But we hit 1.87 right in my time and price zone of my target, okay? My target began early in this year on the 7th of January, and it ended on April. So it's basically saying sometime in Q1, we were going to hit this target price and then back off. And that's exactly what we've done, okay? You can see we have not looked back for interest rates. Now, we'll chop around here for a bit. And if we look at the bond market, all right, bonds are going to trend too. But we had that big counter cyclical move here. You can see the low here hit the COVID low and the 2022 lows, touched it and then bounced right up. I would ideally love to see this move higher because I'm going to be a big short of the bond market if we can get some more altitude in this thing, get some escape velocity here to escape the heavy gravity of this trough down here that was made this year, touching the 2020 low, the COVID lows. So that's kind of what I'm going to be looking at here in the bond market. Okay. In the US dollar, you can see now longer term, I'm going to be short the US dollar. You can see during this crazy ass move that we had this past week, the dollar's been moving higher, but once the euro starts getting in track, it's going to roll back over again. And I think we're going to take these out and find ourselves down here in this area here with the euro a lot higher. And speaking of the euro, if we take a look at it, and these are the euro futures right here, you can see it's sitting right around 1.13 where it closed. We're kind of still in the red for the year, but I think it's going to move back in the green, take the 2022 high price out, and start coming up here to the 1.6 area to the dollar. All right, that's where I think we're going to wind up sometime as we move forward during the course of the year. So that's a little bit about what I'm seeing on those areas. And then, of course, if we look at metals, gold, it's still not above that area where I want to see it get above. You can see we made with this touch of bout of inflation and higher rates. You can see gold has kind of moved up. I'd like to see it get over this 1.80. I do believe it's going to be choppy, but it's going to kind of ride this trend line here. I think it's going to go higher. Remember, I'm calling a 2,000 spot price for gold, but I was calling for it towards the end of this year into 2023. And it can be very choppy getting there, but that's kind of where I see gold. All the other metals are going to be the same as well. If we look at copper, we had a great play on copper off the COVID lows, but that just looks like an EKG diagram of someone that loves Krispy Kreme donuts. It's all over the place. I'm waiting for a breakout for this thing to really get some wind to rock and roll. Same thing with silver. Silver is going to move up too. It kind of moves with gold, but it's got a higher beta to it. You can see I haven't really marked it up very much, but we're at our near our 2022 high. I think it's going to come up here and take these out and move even higher. But look for, if we do get a bull trap move in the equities, you'll see these kind of back off a little bit before it changes course again. Okay. Oil, well, oil is really interesting. There's a lot of pundits that believe oil is going to hit $100 a barrel and then go up from there. You can see the highs here with oil right here, the 2022 highs, just, on Thursday of this week or Wednesday of this week. And now it's kind of backing off a little bit. But I do like oil neutral to higher, right? I was calling for oil in the high 80s, low 90s for this year. The gurus are saying over 100. Now, they know the oil market better than I do, but I'm just looking at price action and the speed with which it moves. When you get a runaway freight train like this and some of the commodities, it generally will back off a little bit before it makes another attempt of making new highs. So I think we're kind of in this neutral to slightly pullback area here before it makes new highs. So we just got to watch how that thing flies. All right, everybody, that's a quick summary of what I see in the markets. Members, we'll go into more detail this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in and check us out. Last year was a great year. This year is going to be harder for a lot of people, but we're going to find some trends and just some of the option plays that we got on some commodities or futures markets, and the way we're trading some of our flies is going to be really great for you guys. All right, everybody, have a great weekend. Enjoy the football for those of you that are football fans. And I will see you members on our weekly market watch tomorrow evening at 8 p.m. Eastern Standard Time. Take care, folks. Ciao.